Since 1996, half of America's public firms have disappeared. And here's our confirmation. People have noticed this before. In 1996, there were different ways to count this, but there were noticeably more than 7,000 public firms in the United States. In 2022, when our measurement goes up until, there were less than 4,000 firms in the United States. So roughly a halving of public firms in the United States since 1996. The halving is frequently brought forward in regulatory and business environments, frequently brought forward by people with a deregulatory agenda. So here's a recent example. Jamie Dimon, CEO of JP Morgan Chase, opinion leader among business executives, in the last annual report to shareholders, he has a section on diminishing role of public companies from their peak in 1996 down to, he has slightly different numbers, 4,300 in 2023 when he's measuring. Is this a problem? Well, this trend, we've got it from Jamie Dimon, is serious. And why is it happening? Disproportionately, the people who bring this forward say that it's some form of over or misregulation of the securities markets. Perhaps more telling or important, quite a number of SEC commissioners over the last 10 or 15 years have said quite similar things. The basic reduced form of the syllogism is public firms as a number have disappeared in the United States, halved in only 25 years. And this is an indicator of overregulation of the securities markets, and our job as SEC commissioners to find out how and where. A little bit more along that later. And then just for educational purposes, some of us motivate, at least in law schools, our classes by talking about the halving, and maybe even some people do this in business school and finance courses, and we ought to have a clear idea of the whole picture of what's going on with the halving. And then to include everybody in this media, business media frequently points to the disappearing public firm and that this is a serious problem. It may be a serious problem, but the syllogism, we argue in this paper, is not correct. So this is just an update of 20 years after Sarbanes-Oxley, people are still beating up Sarbanes-Oxley. The Wall Street Journal quotes the halving of a number of public firms and says it must be to overregulation, and what's the most significant overregulation cited? It must be Sarbanes-Oxley. There are two propositions we push forward in the paper. The first proposition is what fully is happening in the American public firm sector. It's absolutely true that there's been a halving in numbers in the last quarter century, but almost every other measure does not reflect a halving. And the other measures, we can't say we've looked at every single possible measure, but we've looked at a lot. Every other measure that we look at either shows the public firm to be holding its own as a portion of GDP or increasing importance since 1996. And it's plausible that there's a package of changes going on of fewer, more profitable, more valuable, larger firms. We don't make the full case, but we present the possibility that if there's this package, we should be reinterpreting the misregulation thesis. Second proposition that we bring forward is if it's not regulation or deregulation, what is it? Is there a plausible other explanation for this halving of public firms since 1996, if it's not securities regulation? And we push forward two industrial organization hypotheses. We don't make anything other than a secondary contribution to the literature, but we pull forward from the IO literature things that could explain what a lot of corporate law people think is explained by securities and corporate regulation. So let me go through these in just a little bit more detail. At the Securities and Exchange Commission, which is kind of what motivated us to get started on this, I went through with a research assistant what the SEC commissioners have been saying. So since 2012, there have been 16 SEC commissioners, 13 of whom have spoken on the problem, the issue of declining number of public firms in the United States. All 13 who spoke had a legal explanation. About half of them agreed with the Wall Street Journal. It's overregulation. It's probably Sarbanes-Oxley. And despite a noticeable amount of academic work saying Sarbanes-Oxley couldn't have had this kind of effect, people keep saying this. Obviously don't believe the academics who've said Sarbanes-Oxley probably shouldn't have had this effect. But the people who've spoken on this, at least before, haven't brought forward an alternative hypothesis, which we are going to try to contribute to the literature. The other half, I say half say overregulation. The other half who said that they have an explanation for the halving of firms, public firms in the United States, look to a deregulation explanation. We've deregulated flows in private markets, and that's allowed lots of firms that otherwise would have had to go to public markets to raise money. And among securities people, there's a clash between the two perspectives. From our perspective, the two fit together. They're both legal explanations for the phenomenon of the halving of the number of public firms since 1996. One has one explanation, overregulation, and you might have guessed this, we would have guessed this. There was a perfect fit for a party affiliation. Everyone who said overregulation was a Republican. Everyone who said underregulation of private markets was a Democrat. The tiebreakers would be the three who didn't say anything on the issue. Anyway, we put these together and we say this is a legal explanation, even though it's different legal explanation. Meanwhile, at the Federal Trade Commission has been looking at a very similar phenomenon, not an identical, but a very similar phenomenon, which is namely the increasing concentration of large firms in the United States. And again, with the research assistant, I went through all the pronouncements by FTC commissioners just to see what policymakers are thinking, not for the truth of the statements. We, academics, will tell you what the truth of the statement is, but policymakers may have their own view as to what the truth of the statement is. For why there's so much concentration in the United States. Curiously, but humbling for a corporate law professor, not a single one mentioned corporate law or securities regulation, not one. Everyone mentioned some form of an industrial organization argument. A number of them said it's because of the change in merger regulation over the last 20 years, with half saying it's a good change because now we allow efficient mergers, and half saying it's a bad change, we're allowing too many mergers. A significant number, maybe close to a majority, are saying there are new efficiencies from scale, and there's a significant academic literature about the efficiencies of scale, winner-take-all literature. Again, it's really important to get antitrust policy right and know whether these are anti-competitive mergers, say, or anti-competitive reasons explaining the decreasing number of public firms as opposed to efficiency reasons. But for our purposes, we push these two together and we call them IO hypotheses. If one or the other or both in tandem are explaining the decline in the number of public firms, the SEC commissioners can relax. It's not your fault. It's somebody else's fault. So on the paper's first proposition, remember, is fewer firms, but they look much different. It's not as though there are fewer weaker firms. So we looked at a number of measures, and probably some of you will think and say, well, you really ought to look at this too. But what we found when presenting the paper, people would suggest doing this, and we did. And each one comes up with approximately the same result. So we looked at total stock market cap to GDP over the 25 years, net income, capital spending, revenue, and we also looked at employment. So here's net income. So as the number of public firms have, the total net income of the public firm sector doubled as a proportion of GDP. I mean, it quadrupled in the absolute, but it doubled as a portion of GDP. That's an important number. We don't push it forward. Maybe some of you will for other purposes, but by this kind of a measure, GDP in the United States has another 2 or 3%. For an economy as big as the United States, this is a very big number, $1 trillion, going to corporate profits of public firms over 25 years. We don't do anything with this other than to indicate that firms may have halved, but these firms are not weak or disappearing firms. These are profitable firms. Stock market capitalization. Stock market cap's a little bit imperfect on this because the purest case for stock market cap is its forward-looking present value of future dividends, buybacks, and termination payments. Stock market cap is moving in the same direction, significantly up to its peak in 2021, doubling 50% up to our last measurement. We looked at a bunch of other profit measures, mostly because people said, you ought to look at this profit measure, you ought to look at that. And each one returns roughly the same result. None of them have. All of them are stable or rising in significant ways since 1996. EBIT and EBITDA are the only ones that are stable over the 25 years. That is, they're rising, but rising in line with GDP. Capital spending, approximately flat as a portion of GDP since 1996, not halving as the number of public firms were halving. Revenues is a very noisy measure, but also approximately flat. And so our basic evaluation is that by every characteristic we've looked at, other than the number of firms, public firms are today, end of 2022, either more weighty or as substantial as they were in 1996. The only sharply declining characteristic is the total number of public firms. So how would you explain this package? We don't do a lot to say that it's a package, and it's possible that there are separate things going on. But to the extent it's a package, it casts doubt on the over-regulatory perspective. It casts doubt on the over-regulatory perspective because the tone of those promoting the over-regulation idea is that it's weakening the public firm sector, and it's not. Profits are up by a lot. And our recommendation to the SEC is should not use disappearing firms as an indicator of over-regulation of the stock market. It may be over-regulated, but you got to go right to the issue and not say there's a presumption because we've lost so many firms. Or at least you just need a much more complicated explanation. Second proposition is why has this happened? And the whys are, why do we have fewer public firms? And I'm going to go a little bit quickly over this. The IO hypotheses have much more explanatory power than the legal explanation. They both could be in play, but it seems it's plausible for the IO hypotheses to explain the bulk of the disappearing firms. It's not plausible for the legal explanations, either of them, to explain the bulk of the disappearing firms. A couple of IO explanations, I've already mentioned them briefly. One is antitrust related. We don't have the same merger policy that we had in the 1970s, and maybe the increase in mergers explains the disappearance. And the other is an efficiency explanation. Increasing economies of scale or different IO aspects have been shown to lead to greater size, and maybe this explains the bulk of the disappearing firms. One thing I just should mention in just terms of plausibility, to the extent this is a package and we want to explain the rise in profits and the rise in value, the rise in profits is a very big number. That is, as a portion of GDP, we've got, depending on how we count it and which measure we use, about $1 trillion of increase in profits as a portion of GDP in 25 years. The talk about at least the direct costs of regulation is not trivial, but it's measured in billions of dollars, not trillions of dollars. So when people try to come up with what does the securities regulation cost, frequently they come up with what looks like in the abstract to be large numbers, tens of millions of dollars for this company, multiplied by 3,900 companies. But when you do the multiplying, you come up with numbers in the billions. You don't come up with numbers in the trillions. Second aspect, which again I'll be kind of brief on, the overregulation of securities markets could plausibly be an explanatory factor for the disappearance of small firms where the legal costs form a higher percentage of revenue and the like. But it's a much weaker explanation for the disappearance of larger firms. A lot of larger firms in the United States have disappeared since 1996. In fact, what we did, I don't know why I say we, Charlie did this. Charlie looked at, and I helped on this, the number of mergers in the United States since 1996, and just we divided the sample in multiple different ways, but this is the most straightforward one. Large firm mergers with other large firms mergers with medium-sized public firms, and large firm mergers with small firms. As we expected, the market cap of large with large dominates. What we didn't expect, which is a poor fit, not an impossible fit, but a poor fit with either of the legal explanations, by count, most of the mergers in the United States were not large firms acquiring small firms that couldn't handle securities regulation. There are only about 560 of those. Most of the mergers in the United States in the last quarter of centuries have been most of the public firm mergers are large public firms merging with large public firms, or large public firms merging with medium-sized public firms in the middle third of stock market capitalization. There are 2,500 mergers, and remember, we're trying to explain the disappearance has to explain the disappearance of about 3,500 firms. Large firms acquiring small public firms can explain 500. The other 2,500 mergers here are poorly or possibly not at all explained by the legal explanations. And there's more along this line. There are a lot of disappearances of large firms. Disappearance because they're merging into merging with one another. There are a bunch of other IO explanations which I'll just mention, each one of which is worth 20 minutes of discussions. One possibility is what's going on is not straightforwardly a change in economies of scale, but product cycles are quickening in ways that are important and are changing the configuration. It's possible there's a miniature literature of what we call the holding pen aspect of going public. For a while in the 1980s and 1990s, firms went public with a for sale sign. We're going public, but we really expect to be acquired, and we're going public to announce and become more vivid and visible, and then we're eventually acquired. Now what seems to be happening is private equity is much better at moving the private firm right into being a subsidiary of Pfizer. There's the dot-com burst at the beginning, and Jay Ritter has brought forward a different idea that's IO related. Small firms just need to get big faster than they did before. In the economic literature, both the antitrust explanation and the efficiency explanation are in play. There's some, what I think are very good works suggesting that it's increased concentration due to degradation of antitrust from Philippon and Egerton. And there are several quite strong replies from others in the economic literature. If you're looking at the weight of the economic literature, the weight is towards one efficiency explanation or another. Policy implications. So policy implications, if you believe this story, is the tone among SEC commissioners that where public firms are disappearing and we got to do something in securities regulation, they should drop that. The disappearance should not really be a major rationale for deregulating. I'm sure we have overregulation here and there, but we should be looking at it without reference to the disappearing because the firms are so much stronger on every other dimension. Second policy implication is IO, maybe what's really in play. I'm going to skip over this. There's another possible set of public policy implications which we mentioned briefly, but we don't develop, and they're really worth developing. And it's along these lines. We have larger firms for whatever reason. It may have nothing to do with securities regulation, but that has consequences. It has consequences for the way people feel about the place they work, a little bit more alienating. It has consequences for political economy. It has consequences potentially for securities regulation. Securities regulation of firms that are on average twice as big could be quite different from securities regulation of firms that are half as big. We mentioned it, we don't do any analysis of it. So conclusion is a repetition. Public firms are indeed decreasing from their 1996, and in number, they're decreasing quite sharply, approximately halving in the quarter century. The SEC commissioners are worried about it, and they have corporate law and securities regulations explanations for the phenomenon. The thrust of our paper is, one, your worry about it should be different from a sense that public stock markets are weakening in the United States. By every other important measure, they're the same or increasing, twice as profitable, investing just as much, similar revenue levels, and so on. And hence, what you should be thinking, SEC, is that the configuration has changed, but their weight in the economy is approximately the same as it was in 1996. And expand your horizons. The IO explanations have more traction as powerful explanators than the over-regulatory explanation. Thank you.
Let me start by criticizing the organizers. What were you thinking of putting me up to discuss this paper? Because Mark Rowe was the person that essentially was instrumental in bringing me into academia in the field, and the very limited knowledge that I have about the subjects we discussed was imparted by Mark. So ever since, I've been trying to imitate Mark Rowe, up to actually wearing pink shirts and blue blazers. So what do you expect from this discussion? Probably that it doesn't take too long, because then we can get to lunch earlier. So the summary of the paper. So I think it's pretty straightforward. You can summarize it in one sentence, which is in the paper. Public firms, by every measure other than the number of firms and IPOs, are as important in 2022 as they were in 1996. This is an important question, obviously, as we have learned about the policy implications that a different explanation might potentially have. And the research design is straightforward. So it's a very, very simple empirical strategy. So it's really, with regard to that, Occam's razor and steroids, because there's nothing superfluous. There's no fancy identification, which of course is sad, because you cannot talk about where to gloss its standard errors. But the thing is, this is extremely convincing. And the result is clear. There's probably no securities overregulation driving the decline of the public firm. And I find that extremely intuitive. When I first was confronted with this paper a year ago, I selected it for another conference, and I said, okay, this is exactly the paper on how you should write it. And now I'm supposed to comment on it. So it's sort of challenging. But maybe the second part, which is more intuitive, it's not really taken to the data, is a little bit something where I can talk about. But I will do that in a second. And then the policy implications, once again, I think are straightforward. as far as the subject matter is concerned that we are up to discuss here, securities regulation, corporate governance. So my talking points, essentially, Mark mentioned that everybody comes up with an additional data point that they think should be discussed. I have one too. Then I just want to somewhat caution the very, I think in the presentation you were a little bit more parsimonious than you are in the paper, because in the paper you're just throwing out the securities overregulation hypothesis as policy relevant in total, and I think that's probably an overstatement. And then I have something more what you could probably do in order to bolster the I/O explanation with the data that you have. And then I have some quibbles, which time permitting, I will also go into. So first, what about market liquidity? So the concern in the policy circles and in the regulatory sphere are that investors get hurt, particularly retail investors get hurt. Mainly, this is a distributive concern because the concern is that these investors do not participate in the welfare creation that happens in the private sector. You can wonderfully rebut that hypothesis. But what about if markets have lost efficiency when it comes to liquidity, price discovery, and more liquid markets? You don't have to dig up these numbers yourself. They're all there. But I think you could do that. And it's pretty similar like what you do with employment. So it's certainly not driven, or it's probably not driven by securities regulation, et cetera. But employment is neither. And you could make that point in order just to be complete and say, okay, there's really no problem here. And then let me just revisit the policy debate in the securities regulation space, because even if it's not a first order concern, it may be there as a subcurrent. So it may still be there. And of course, I think you very convincingly show that the I/O determinants that are at play are potentially significantly more powerful. But we somewhat rarely accept monocausal explanations for phenomena that we observe. And there is one possible explanation for what we see. All the higher profitability, the higher market cap, et cetera, may be there despite some inefficiency in the securities regulation. So the fact that you observe higher characteristics, higher data points doesn't explain that it could not be higher if it wasn't for these stupid securities regulation. So in the paper, you didn't make it in the presentation, but in the paper is the statement that your securities laws are adequately calibrated. So they are exactly where they should be. And that's something that I think you cannot really necessarily take from the data that you have. And you can also somewhat feed this legal explanation, as you call it, the securities overregulation hypothesis into the I/O explanation. It's somewhere in the paper, but can be somewhat more prominent because you're discussing economies of scale and fixed regulatory costs, but you're doing that mainly for stuff like environmental regulation, et cetera. But the compliance with securities costs has exactly the same characteristics. It's a fixed cost where you can spread that over larger units, and therefore it may amplify concentration at the margin. And that, I think, is not only a problem for the antitrust people, because from a policymaker's perspective, of course, no part of the legal system should actually be amplifying undesirable results. And we also know that regulation is a barrier to entry for small firms. So that is something that is well known. You somewhat do that because you test for firm size and how small firms are affected. But the thing is that, again, there might be offsetting benefits, particularly for small firms. They enjoy the benefit of being public because they have a growth story or something like that. And that brings me to my next point. You're talking about costs of compliance with securities regulation in a way that assumes that they are identical across firms in similar industries. You actually say that explicitly. But the net costs for a firm might also be determined by the benefits that they have from being public, and they might differ across firms. So it might be actually more firm specific, depending on how your financing needs are actually acute in the sense that you have to address public markets. So the distance to a public offering might distinguish firms. And then, of course, how much trading is going on in your stock also determines how effective the signals that you receive from the public market are with regard to your corporate governance, particularly maybe executive compensation and other stuff. So I think the benefits diverge, and therefore the net cost might also diverge. And therefore, you could probably do a little bit more in distinguishing these firms and how they actually are affected by securities, the burden of complying with securities regulation in light of the different benefits that they might enjoy. Then something that you could probably also do with the data that you have, the sectors of the economy where this scaling up might matter more might differ. And you can probably do something about this because there's anecdotal evidence that, for example, in the biotech sector, you still see very early stage IPOs, which you don't see so much in the tech sector. And therefore, if you split your sample and look along industry classifications, so the classical Knight's codes, if you do that, you might see something that sectors are affected differently, which might tell you something also how plausible this IO explanation is. And then I have just, I was grappling with the fact that you make in the paper the point that the public firm is benefiting largely from this reconfiguration. But I was wondering why it's only the public firm. So what's really the comparative advantage of the public firm for this scaling up? So why is it not happening in the private sector? Because there you could probably make the case that there something similar is happening, but you show that many metrics that you're using, the uptick, the effect of the IO explanation, if you will, is concentrated in the public sector. And then I just want to turn your attention to one fantastic paper by Mark Lamley and Mark Wornsley, which tells us something about why the concentration is actually happening. And it's a very, very, it's a very, very dark paper in a sense, because what they are showing is that aging tech giants from the Valley have just developed a very, very skillful way of crowding out competition by simply buying or co-opting. So it's not only mergers, which is in your data, there are more subtle techniques, if you will, but still, I think this is something that you could also mention at least. As I said, I'm not going to use my 10 minutes, so my 20 minutes, the remaining 10 minutes, but I have some quibbles. So in your paper, you're mentioning that the better access to capital for private firms is something that might drive this. It remains relevant, I think, even for your IO hypothesis, because staying private for whatever reason is something that feeds into your idea that the firms go public, but at a later stage or in a different way. And you mention the 1982 relaxation of Reg D, which is making it easier for issuers to attract private capital, but you're not mentioning, which I think is the more relevant determinant here, the relaxation of the Investment Company Act, the registration requirement, which is the investor level, because you're rightly saying in the paper that the money that goes into the private firms is actually still coming from institutional investors. And I think the institutional investors since 1996 have a little bit, it's easier for them to acquire larger sums of money. Then something that I think also can be established in a more nuanced way is the structural break 1996. It's somewhat intuitive because you've simply taken the peak of the number of public firms. But if you're going into this IO explanation, it's not so clear because many trends that you're mentioning that are driving this, I think, start significantly earlier, but they don't show up, obviously. So there must be something going on. So you're mentioning, for example, increased international competition. That is something that I think the US economy has faced during the 1980s as well, from Japan, Germany, and others. And then just a very tiny thing, I think the phase of 1996 until 1999 is exactly something that might explain why you see a relatively flat development with regard to the metrics of the public firm, but not in profitability, where it's actually somewhat increasing significantly. And one reason for that could be that during that period, the public firms were particularly not very profitable, because the IPOs during the dot-com bubble, they had a huge market capitalization, but they did not really generate many profits. So therefore, from that relatively low level, that is something that may want to exclude at least. So the general idea that I have is maybe you can use, without much increasing your effort of data collection, somewhat longer time series to really see what the pre-trends are here. Margaret Blair has this paper which essentially shows that despite all the disruptions that we had during the 20th century, the public firm has a relatively stable role. So the interesting question is, how does that feed into your specific 1996 to 2022 explanation? The rest I skip, because that's more something that is an editing thing. But I think I leave it here and leave more room for discussion, because I have no criticism. Thank you.
Thank you so much, Tobias. We welcome Mark back if you'd like. And if you'd like to take a moment and respond, you're very welcome. And then I'll start building a queue, so if you could signal to me.
These are very helpful, useful comments, and the next draft will be a better draft. Makes me proud to be involved in the Tobias 25 years ago. A few things to mention. The Lemley paper is relevant particularly for the antitrust IO hypothesis. Probably should be mentioned. There's a very dark side to this that doesn't involve securities, potential dark side that doesn't involve securities regulation, and we're trying to avoid evaluating the efficiency versus antitrust explanation and simply say these two, either separately or in tandem, are much stronger inputs to the large public firm and the whole sector than securities and corporate regulation. I won't go over the specific. There's several things that are several additional tests and refinements of the data that are worth doing. I should say one thing that we do say in the paper along the lines of what securities regulation consequence we should have for this analysis. We don't want to say that this indicates that securities regulation is just fine. What we want to do is defeat the proposition that the disappearing firms means that securities regulation and corporate regulation is doing something really bad to the whole spectrum of public firms. We want to say at least it's open that securities regulation is on average okay. Points about market liquidity and spreads and similar are, I think, well taken. There are consequences. Some of the consequences are negative of having much larger firms, even if it has nothing to do with securities regulation as a cause. There are securities regulation things that come into play because we have much larger firms. IPO profits in 1996, that might have the IPOs of 1996 might have an effect on the number of firms, but it shouldn't have an effect on the change in profits. So we're looking at the aggregate profits of the public firm sector. So even if we have lots of IPOs of firms that contribute nothing to profits, we're not looking at profits per firm, we're looking at profits of the whole of the whole sector. Where it is particularly relevant is, have these firms' disappearance and the decline in IPOs, is that sufficient to explain the halving? And most of the evidence that we're trying to present is it could explain something, and it probably does explain something, but it has a lot of trouble explaining the halving. And maybe we should stop there. I'm interested in what
I think that's a wonderful time, because we have a long list of folks. So I'm going to take several questions, if that's okay with you, Mark, to get us started. So first, we'll go to Simon, and then Martin, and then Roberto and Jeff. And then I did see all of the rest that signaled to me, so there's more coming. But let's start with those. Simon Whitney.
Thank you. Yeah, really interesting, great paper. Really enjoyed the presentation and the discussion. I suppose my question or comment is about the relative share of GDP. So you tell us that the share of GDP of public firms has stayed the same roughly, or actually increased a bit. I wonder what's happened to other contributors to GDP. So my hypothesis would be, I haven't got the data, but my hypothesis would be that over that period, private equity share of GDP had gone up. So somebody's share must have gone down. And the question is whose share of GDP has gone down over that period? Is it family firms? Is it government? And then I think the question is, if it weren't for example, over-regulation of securities markets, would some of the loss of GDP from that part of the economy have gone to the public firms rather than to, say, private equity? So I suppose the question is, have you looked at how the balance of GDP has changed and thought about whether or not over-regulation of the securities market might have caused the reduction to go one way rather than to the public firms?
Martin?
Yeah, thanks. So with apologies, that's going to be a very finance question. So I was fascinated by your finding that earnings before interest and taxes were flat relative to GDP, but not net income. So that makes me think, so it must be that either interest or taxes or both are down. And I didn't know that. So is it that firms delevered, or is it that they just stopped paying taxes? Anyways, I was very interested in that. So, and this, yeah?
The reason we did this is since the financial crisis, Fed has kept interest rates very low in the United States. And the question was, has this, if we eliminated the reduction in interest, would that have halved profits? It didn't. And taxes, it's the 2017 tax cuts, so there are less taxes. If there's a moment, I'll talk about how that actually could be endogenous to powerful public firms. But that's the reason we did it. Yeah. It's flat, not heavy.
So thank you. But so if the broader point of the SEC commissioners is that the regulation is hurting the capital owners, right? So then we basically should care about free cash flow, whether you call it net income or you call it interest, doesn't really matter. And I mean, I guess the finding also works, right? So you say EBIT is flat. So you say, well, that kind of does the trick for your message. So the second question I had was related to what was said previously. So the National Securities Market Improvements Act, the 1996 law, right? So that made it easier for private equity firms to find money. So relatively, private markets got deregulated compared to the public markets. And that seems to be the broader argument, that the deregulation in the public market has not kept up with the deregulation in the private market, so to speak, right? And there's nothing here that rejects that. I just wanted to see if you agree with that statement or not. Thank you.
Since that one relates to the first question from Simon, let's pause and give Mark a chance to respond to those before we go to Roberto and Jeff.
Okay, so we understand this, and we were partly motivated at some point to compare public markets to private equity and private markets. As the paper got longer and longer, Charlie and I said, we don't have to do this to make our point. And secondly, it's actually hard to get the data. It's harder to get the data for private developments. And third, let's look, but that's a paper for the future. But I can tell you a little bit of what we did. I can tell you what I did in the college. What I did was, here's a pitch book from the private equity industry. It's not exactly contribution to the economy, but it's close. Pitch book from private equity industry. So here's money in private equity since 2006 to 2021. I wanted to use this as the first time series that we could see and analyze. And in fact, it's rising, fitting with deregulation of private market thesis and the like. And here's how I want to do it, and then I'll tell you why Charlie said we should or can't. We should. Well, I'll tell you why. Right. When we did this the private equity industry has no explanation of where these numbers come from. I was, because I'm a law professor, not a finance professor, I was perfectly happy to do, assuming arguendo that this is good data, what's the consequence? And Charlie says, that you can do that as a law professor. You can't do that as a finance professor. Once you present the data, you have to have some explanation of where it came from, what its strengths and weaknesses are, and there's nothing in the data more than this. But here's what I did, and then I'll tell you what. So I just transferred this text set. Then I scaled to GDP because for some reason the private equity industry never scales to GDP. Everything is up, and everywhere else in finance people scale to GDP, but it's still up a lot. Then put it onto a point chart, and then put it. This is private equity, and now the top orange line is stock market capitalization. These are imperfect comparisons, but you get the general picture. The slope is about the same. Something over the last 25 years was making financial assets much more valuable, and it was making public firm financial assets more valuable, and making private equity firms much more valuable. It might have been the decline in interest rates. It might have been something else. And the last thing is, where is everybody growing from? One is just maybe it's the same assets, but they're just more valuable for some reason, like very low interest rates. Another possibility is private equity growth. Some of it, there's kind of a hidden assumption in a lot of discussion that it's at the expense of public firms. A lot of it just intuitively, this is not based on anything other than my reading the New York Times. A lot of it seems to be a reconfiguration of things that were already private. So the big one, Uber. Uber is not really at the expense of public firms. It's at the expense of taxi companies. It's at the expense of car services. It's at the expense of, in my family, my wife had a car and I had a car, and one of the cars always sat in the driveway. So we sold one of the cars because whoever needs to drive the second driver of the day can always take Uber. So a lot of the reconfiguration in private markets is a reconfiguration of things that were already private, conglomerating because IP is better, a bunch of different retailers into a better, dollar market.
Great. So we'll take Roberto and then Jeff, but to give you a sense, Mark, I've also got Kyung Hoon, Stavros, Yair, Kobe, and Lee Jin. So Roberto.
Okay, well, we don't have lunch.
Indeed.
So I'll try to be quick, and it's partly related to this. And I'm trying to think about what the correct baseline for the normative question should be. And I took a quick look at Fred, and it shows that the corporate profits as a whole have gone up from 1996 more or less the same slope of your graphs. So I'm wondering whether this is a rising tide for everyone, and your back on the envelope prohibited for finance journals, but pretty persuasive to me exercise here shows is maybe there's been a rising tide for everyone. And if that's the case, and we do care about firms being public for a number of reasons that have been mentioned and other reasons, maybe we do care about the decreasing number of public firms, because the counterfactual would be not this, but even more public firms, even more profitable, even bigger public firm sector in the counterfactual without Sarbanes-Oxley, assuming that Sarbanes-Oxley was causing a decrease of number of firms. And another quick question I had is that, from reading René Stoll's, his work, I got away with the impression that the importance of public firms was actually decreasing in the economy. And I was struggling to reconcile the two things. And they use different metrics, not just profits scaled to GDP, but what they call contribution to GDP or value added, if you thought about this. and whether profits is the right metric here.
Thank you, Roberto. Jeff.
So I mean, this is to try to figure out what's going on, and I wonder if the rise of the institutional investor has played a significant role in the decrease in the number of firms, in the sense that for an institutional investor for an investment to move the dial, as it were, right? They have to make a minimum investment of X. And as there's been more money flowing into concentrated asset managers, in a sense, the threshold below which it makes sense for them to invest money will change. And so, in a way, you know, this is neither an I or, this is a different sort of IO story. It's about how investment is made away from sort of, you know, the household to successive levels of intermediation. And that's led to, you know, sort of below a certain size X, the cost of equity funding is very high because you're depending upon, you know, a different group as opposed to, you know, above a certain threshold, you know, institutional investors play a significant role. Josh Mitz also tells a story that a small firm that doesn't have a smaller cap firm that doesn't have access to an institutional ownership market is also much more susceptible to short seller raids that can disrupt the business activity of the firm, because the CEO needs to spend time explaining to, you know, the stakeholders why the firm is not in trouble. So it could be that there's a securities market story, but it is not, you know, the either the under regulation, but it's an IO story in basically how investments are made.
Brief response to either of those?
Sure.
Excuse me, this is being recorded. Could you please speak into the mic?
Okay. Roberto, yes, Fred is important. At a minimum, what I can say right now is we're not seeing a decreasing portion of profits to public firms that presumably would have been leaking out to private firms. What really counts is probably the percentage of total profit that's in public versus profit. I don't think that would be hard for us to calculate because we have the public, and with Fred we can have the total. And I think that's a good comment. We should look at that too and see if the percentage is shifting in some radical way. The Schwingerman and Stoltz article is an important article that is in this general genre. For the most part, what they're looking at what happened to the public firm in the United States since 1990. And it turns out that makes a difference. So we are doing 1996 because that's the peak of the number of firms, and we're looking at the syllogism. Decline from the peak means overregulation. And what they find is there's a lot, by various metrics, deterioration of the public firm in the United States in the 1980s, 1990s. Actually, some of their data goes back to 1970. So, for example, total employment declined significantly as manufacturing cratered in the Midwest. And they do have this measure, which I did look at because you mentioned it to me a while ago, last week. They do have this measure of general contribution, and the general contribution declines and then flattens in the 1990s, which is the period that we're looking at.
Mark, I'm going to encourage you to be brief because we've got a few more, and it's going to be a lightning round on those. Keep that in mind for those on the queue.
Let's do the few more.
Say again. Oh, yes.
I
added one, Mark.
I've just got to be absolutely right that institutional investors, the big institutions that don't want to invest in small firms because their cost of evaluation chew up whatever profit they could end up making. And I think that's relevant. One of the things I'd reemphasize is what we saw is a lot of the disappearance is very large firms. So this would contribute to the disappearance of small firms, and I'm sure it does, but it would have trouble explaining the disappearance of, I count, 2,500 large firms over the last 25 years.
Great. Well, I did get in advance like a few minutes from Elaine and Suzanne, but we know that we need to stay in their good graces. So very quickly, Kyung-Hoon.
Thank you. It's already pointed out by the presentation and other colleagues, but I still think that it is important that the actual impact of the regulatory burden is very different depending on the size of the company. So to borrow the language of your paper, the public corporation is not a poor place to do business, hence the twice the profit, but it may be a poorer place to do the business for at least the smaller companies. So what do you think about this phenomenon? And what is your kind of what do you think the policy implication of this phenomenon?
Thank you. Stavros.
Hi. I was wondering if you know whether this worry that the SEC commissioners are expressing about the number of public firms is a new phenomenon or an older one. Were they always worried about that? Is it something that they just discovered? The SEC hasn't traditionally seen capital formation as part of its mission. It's more of a disclosure and anti-fraud agency, so it would be interesting to see how far back this interest goes.
Thank you. Yair.
Yeah, just wondering about like the inframarginal versus marginal firm here, because like we know that superstar firms have done extraordinarily well. So showing just on like every measure possible, while like I think the SEC's concern is much more about the marginal firm. So I'd be curious for like measures of like firms of a certain size that are kind of marginal. What percentage of those are public versus private, and how has that been changing over time? That would seem to address more squarely just the marginal firms.
Thank you so much. I have Kobe, Lee, and Elsa. Kobe.
Hi, this is really interesting. So I think 21 and 20 were outliers in the number of IPOs. So suddenly, again, just estimates around 1,500 IPOs, around 1,000 in 20 with 21. So I think, and there was no legal change. So I think it's interesting, to examine them and to see variation in the number of public companies in situations like that and try to see what was going on. The other thing I should mention very quickly is that Israeli regulators are also always concerned by the number of publicly listed companies. So it seems like a phenomena that's related to a lot of regulators. And there is a question why they are so obsessed with the numbers. I mean, is it the idea that, when we get small companies, we can create competition because through the public markets, they can compete? Is there a self-interest to these regulators by, having more companies, capital markets, the local capital markets looks better? Or is this question of volatility? We have less companies, they are more correlated. So do they have an explanation of the why they care about the numbers?
Lee.
Very nice paper, and I learned a lot. Just one thought about this, you had a figure comparing the large acquisition versus a large small acquisition, and you show that not only the market cap, but also the actually number of incidences of large firms acquiring small firms seems to be, smaller relative to the large acquisition, which is nice. But just want to play the devil's advocate a little bit here. Imagine I'm a small firm thinking about two routes. One, I can be listed on the stock market myself, and then two, I can be acquired by a bigger listed company. And then now, if I want to just argue kind of consistent with the legal explanation, which in my mind seems to be saying that the legal changes is shifting the cost and benefit of small firms, so that they might be more inclined to not be listed. Now that this private firm might think, well, given this legal consequences of the recent changes, might be more, for me, it's better to be acquired by a large company. But then your data would not actually put that into this comparison because you don't have the data of the small acquisition for the target firms being a privately held firm. And maybe that's because of the data limitations. So I don't know whether that's something that you can add to maybe as an appendix to your paper. Another quick comment is similar to what Jeff was talking about. Maybe this is part of your IO explanation, or coming from a finance perspective, I want to call it a capital market explanation, which I call a catering theory, which is that the investment community would probably prefer larger firms, larger public firms than small public firms, because you probably are aware of the so-called size premium, which essentially says that smaller firms command a higher return on investments, or put another way, they have been more heavily discounted by the stock market. So if you're a smaller firm, you might want to combine with other smaller firms and be listed rather than being a bigger, rather than being a small firm. So in that sense, the taste of the capital market over the last 20 years or so might dictate the shift towards bigger public firms than the smaller ones. So that could also be an alternative explanation. You could probably combine with your other IO explanation for this.
Thank you. Elsa, last question.
Can you hear me? Yes. My question really is about, you have two main explanations for this trend, and I think you should look harder at taxes, because I think the carried interest tax loophole is super important. It's led to a lot of things being held by private equity that otherwise would be public. And even though that loophole has always been there, it's become more important because towards the end of the 20th century, the tax rate on personal tax rate on capital gains really fell a lot relative to the income tax rate. So it became very strong incentive to stay private. I wanted to just read to you the conclusion of a study on trends in income distribution in the US in the last 20 years.
Just remember, Elsa, it's a lightning round.
Yeah, okay, just a young colleague of mine called Clara Martinez studied income distribution and said, we show that the rise in income inequality in the US over the last 20 years is mainly driven by higher capital gains on private investments at the top. And I'll leave it at that.
Well done. Thank you. Okay, so Mark, we're at time, but you can have a famous 1 minute to conclude. Yeah. Thank you so much.
Tax. I'm prepared to accept that tax plays a significant role. I just point out that the theme of the paper, the thesis of the paper is you can't draw from the decreasing number of firms, public firms, that we've got a deep securities regulation problem. It may be that we have a tax problem. Similarly, that statement of the thesis relates to the possibility that we've overregulated something in the small firm sector. And if we've overregulated something in the small firm sector, we ought to do something about it. But we should not be inferring from the decrease in public firms that we've actually overregulated something in the small firm sector. We do have the information on public firms' acquisitions of private companies, and they went up, but they didn't go up enough to explain the decrease of 3,500. So if it's a multi-factored thing, it could be a multi-factored thing.
Perhaps you want to also answer some at lunch. Also, we could answer some at lunch too. Yeah.
One I should say from Yari's point about the inframarginal and the marginal, we did do a variation of that. So we looked at this. We looked at the trend lines without the FANG firms. We looked at the trend lines of the non-S&P 500. It's not exactly what you look, but it's in the same genre. And the non-S&P 500 are going up at the same rate, which suggests that, well, tells us that something is happening all across the public firm sector in the United States. It's not just either the S&P 500 or the FANG firms that are driving. One.
Fantastic. That was amazing. Thank you to both parts of this amazing session and to ECGI. We continue on.